Welcome back, dear learners. Before the ad break, we calculated depreciation using the cost price method. With me here, I have the second method, the diminishing balance method. And the information reads, the following balances appear in the books of Ndlovu traders on the 1st of March. So 1st of March is the beginning. That means this financial year will end on the 28th of February, the following year, 2022. We have equipment of 300,000 and accumulated depreciation on equipment is 57,000. A new cash register was purchased on 1 September for 120,000. Depreciation is calculated at 10% per annum on the diminishing balance method. So it means we have an old asset as well as a new asset. Let's start with the old. The old one has a cost price, and the cost price is 300,000. And that old one has accumulated depreciation, and the accumulated depreciation is 57,000. It would then have a carrying book value of 243,000. When you calculate depreciation, you then say the carrying book value, which is 243,000, multiplied by the rate, multiplied by the time, that is 12 over 12, because it is an old one. We had it from the beginning. So the depreciation therefore becomes 24,300. This is for the old one. Remember, we also had a new cash register which was bought for 120,000. So I'll come here for the new one. It will not have accumulated depreciation. Why? Because it is new. We've just acquired it this year. It was not there in the previous years, so it will not have accumulated depreciation. So I'll come here, then I'll say it is 120,000 multiplied by the rate, which is 10 over 100, multiplied by the time. We had it from the 1st of September. And remember, our financial year ends on the 28th of February. So it will be 6 over 12. If you punch that in your calculator, you will get 6,000. My depreciation therefore becomes 6,000. When you have calculated your depreciation, it therefore becomes easy now to record it in your general journal. The quickest way, let's add these two amounts. That is my 24,300 plus 6,000. That is going to give me 30,300. I'll then come here and I'll say the account debited is my depreciation. I'll debit depreciation with 30,300. And then I will credit my accumulated depreciation on equipment. And the amount is 30,300. Once I've completed my general journal, it becomes easy now to complete the general ledger. In my general ledger, I remember that equipment is an asset, so on the debit it will increase. On the credit, it decreases. I have my balance brought down. I remember that I had 300,000 worth of equipment at the beginning. And then we purchased a new piece of equipment for 120,000. We have calculated depreciation, and the depreciation was 30,300. So I come to my depreciation account, I'm debiting it. I'm debiting it because it's an expense, remember, and it's 30,300. And then I come to my accumulated depreciation, and I'm going to credit this account But before I credit it with the 30,300, I remember that I had balance at the beginning on accumulated depreciation, and that was 57,000. So I then bring my 30,300 as well. This is how you would post to the general ledger. And then we will now complete the accounting equation. In the accounting equation, I would debit my depreciation. I would debit my depreciation, and depreciation decreases owner's equity. So I'm coming here to say minus 30,300. And I will credit accumulated depreciation, and then accumulated depreciation decreases my assets. So it's going to be minus 30,300. However, there is no effect on my liabilities. Dear learners, let us go for an ad break, and I'll see you shortly.